Hey everybody, it is time for managing an options portfolio. It is Wednesday. My name is Brent Morse, and I join you each week at this time, talk about a variety of option trades. And today I want to kind of focus on vertical spreads, short verticals versus long verticals. Which is better? What's the difference? We'll hit that up in just a little bit. But before I get too far into this, let me just remind you that you can follow me on X if you like for additional financial content throughout the week at Brent Moore's CS. And also, I'm joined by Connie Hill in the chat. I appreciate Connie. Connie, you can follow her on X as well at Connie Hill CS. And as you have questions, feel free. You can type those in the chat between Connie and myself. We'll do our best to get your questions answered. Now, options do carry a high level of risk and are not suitable for all investors. And multi-leg option strategies will involve multiple transaction costs. The paper money software application is provided for educational purposes only. It doesn't assign short options early, so that's something you got to be careful of because in your live account, there is a difference there on that. The material today is intended for general informational purposes only, and Schwab does not recommend the use of technical analysis as the sole means of investment research. All investing involves risks, including loss of principal. Past performance is no guarantee of future results there. So, hey, let's move forward and let me bring up the Thinkorswim desktop software. And this is the S&P 500. We're down again today. We're below that 20-day moving average. So far, we're holding that 50-day in check, but we'll see where it goes from there. Good to see some familiar names in the chat as well. So what's a long vertical spread? What's a short vertical spread? Well, what's a vertical spread? A vertical spread is where we're going to take two contracts. They can both be calls or both be puts. And we're going to buy one and we're going to sell one. Same expiration date. Okay, that's the key on a vertical spread, same expiration date. If you do it such that the long price, the price of the one you're buying is more expensive than the one you're selling, that's going to be a debit spread. It's going to be a long vertical. When I say debit spread and long vertical, same thing. If the one you sell is a higher price than the one you buy, then that's going to be a credit spread. And so credit spread, short vertical, same thing there. But we're often confronted with the choice of which should I use? What should I do? What's the pros and cons of both? Well, before we do that, I want to give you a specific example because I think it's easier to learn through specific examples there on that. But let me just mention this. There's two types of long verticals and there's two types of short verticals. If we just talk about long verticals here for one sec, you can do a call long vertical, okay, which is a long call spread. So I'm going to call long call vertical. I'm just abbreviate long call vertical. We're going to buy a call or do a long call. You could call it either way, same thing. You're going to buy a call at a certain strike price and you're going to sell a call at a higher strike price. In this case, you want the stock to go up. It's bullish, okay? A long call vertical is a bullish trade. It's also a debit spread, DB, for debit. It's going to cost you money up front. Hopefully the price of it goes up and you can sell it for a higher price. Okay, so that's a long call vertical. Okay, well, let's do another type of vertical. Another type of long vertical. Another type of long vertical is a long put vertical. And in the case of a long put vertical, you're going to buy a put. You're going to sell a put at a lower strike. And that's going to be a bearish trade. And one way to think about these is as opposed to just buying, and it's a debit spread, as opposed to just buying a long call, which as you probably know is a bullish trade, a long call vertical is similar in the sense you're still buying that long call. That's the same, but you're also going to cut down the cost of that trade by selling that short call there at the same time. Same thing with a long put. You can just buy a long put, great. If you do a long put vertical, you're going to buy that put, no doubt, yep. But you're also going to sell a put, which is going to help to offset some of the cost of the trade. Now, it's nice to pay less, but it also limits the potential reward of the trade, at the same time limiting the risk of that trade. So those are your long verticals, okay? So that's how that is. But when you come up with this, you're going to have a choice. You can also do a short vertical. And if you do a short vertical, there's a couple types of short verticals. And again, in just one sec, I'm going to compare a couple. But a short vertical, you can do a short put vertical where you're going to sell a put and you're going to buy a put at a lower strike. It's a bullish trade, okay? It's a bullish trade. And it's a credit spread. You sell it up front. And ideally, the price that spread goes down. The price of the spread goes down, but it's bullish. You want the stock to go up, okay? In the case of a, in the case of a short call vertical, you're going to buy a call, you're going to sell a call at a lower strike. It's a bearish trade, and it's a debit spread, okay? And you want the stock, you want the underlying stock to go down, okay? So it kind of begs the question, if a long call vertical is bullish and a short put vertical is bullish, when do I do one versus the other? What's the difference there? Well, let's take a look. And for our example here, I'm going to look at CRM, Salesforce. It's a company many of you are familiar with. And on this stock, what I'm going to do is I'm going to look at this and I'm going to throw on a technical indicator that we often look at, and that's a volume profile. And with the volume profile, just as a reminder, in case you don't remember, it tells you what price the stock has traded at in terms of volume. The most times it's traded at that price. Most times it seems to be trading up in this range, kind of around that 185-ish mark there. And you can see, so this is over the past 6 months, okay, over the last 6 months. And you can see this is kind of the area it's traded. Right now, our stock's down here. And the theory with this is very often the stock will trade where it's traded before. No guarantee. This stock can go straight down here. But I've got a support level kind of in this area, probably a resistance level kind of in this area. My thought is, from a technical standpoint, we may kind of revert closer to that higher traded area, okay? The more highly traded area, and therefore we're going to be slightly bullish on the stock, okay? Now, if I'm super bullish on the chart, on the stock, and I think CRM is just going to go up and up and up, I probably don't want to limit my potential gains by doing a vertical. I'd probably consider buying the stock or buying just a long call or something like that, and still take advantage of the stock going up, but also limit the risk. Then maybe I'll do a vertical. So we have a couple different choices. Let's look at, for example, a short put vertical. We'll start off with a short put vertical on this trade here. So I'm going to go and I'm going to make this, I'm going to do my 2 puts. Remember, I need to sell a put and I need to buy a put. I'm going to do them out of the money here. In this case, I'm going to say, I think the stock is unlikely to go below kind of where my support level is, which is around 165. So I'm going to sell a put around the 165 level, kind of in that area. And then I'm going to go down a little bit and I'm going to buy a put below that level. My goal, the stock to stay above this 165 level here. That's the goal. That it's going to find some support and bounce up. As long as it does so, we'll probably be in decent shape on this trade. At expiration, if it's above 165, it should expire worthless. Okay. Now, with a short option, there's always a chance of early assignment, but we're doing it out of the money. That should minimize that stance here. Okay. Just as a reminder for everybody, this is the volume profile. It's one of your studies you can pull up right there. Use that flask if you want to pull it up. It's called volume profile. So let me clear my drawings. Let's go and let's do a trade here on this. I'm going to look and sell the 165 put. I'm just going to go out 37 days, about a month. I'm going to the monthly contracts here. Probably don't need 40 strikes. Let me do this just to cut down the clutter here on this. I can go out to the weekly contracts. These tend to be a little bit more liquid. I'm going to sell this 165. Now, we identified the 165 by saying that was at a support level. We didn't think the stock was going to go below. Another way to consider is to use your delta, which tells you how much the stock is going to move and how much the option is going to move in relationship to a $1 move in the stock price. But it also gives you an idea, a general idea of the probability of the stock closing in the money. We don't want it to be in the money. We want it to be out of the money. We want the stock to stay above 165. In this case, it's telling us roughly a 32% chance. We're going to sell this contract. Put a little S next to sell. We're going to buy this contract. This is for my short put vertical. And if I do so, what I can do is I can go up here. I can click on the bid price to sell, minimize that. I can hold down my control key, click on the ask price to buy, and this is a vertical spread. Okay, that's a vertical spread right there. And what I want to do is I want to enter this order, but I want to, ultimately, we're going to compare the two here on this. Now, everybody, there's a survey link in the chat. We appreciate your feedback. Always, we appreciate your feedback. Now, but I want to point out something on this. We said the stock, we want the stock to be above 165. Well, right now it's about 174. That's great. If the stock goes up, we're above 165, it's great. If the stock stays roughly sideways, we're above 165, that's great. If the stock goes down a little bit, we're still probably going to be above 165. That's great. Now, if it goes down a lot, we're not going to be at 165, and it's not so great. But that's the view of this, and that is this is a typical way we do a short put vertical in this webcast. It's a higher probability trade. But as you know, there's no free lunches out there. A higher probability trade comes with a downside too. And that downside is the reward to risk. Let me click on confirm and send. Click on confirm and send. Here's the downside of it. My max loss is $343. My max gain is $157. So that's the downside of it. Higher probability trade, worse reward to risk ratio. That choice you have, probability versus return on risk or reward to risk, doesn't just confront us on the vertical spreads, it confronts us on a lot of different types of trades. And it's kind of a teeter-totter, a seesaw. The better the probability, the worse the reward on risk, and vice versa. In general, with these short put verticals or short call verticals, which are the bearish equivalent of this trade, I guess, or bearish analogous trade of this, these are going to be higher probability trades when we do them out of the money, which is what we're doing by looking at that delta and choosing that delta, I don't know, the 30, 35, under 40 probably range, we're going to get the higher probability trade with the worst return on risk. Let me enter that trade here. Here's how I'm going to do it. I'm going to read through, make sure this makes sense, make sure from a technical standpoint, we think the stock's going to stay above the 165 level. We already looked at the chart on that. I'm not going to do that again right now. It looked like the stock was going to stay above the 165 level. Hey, we could be wrong. We looked at the probabilities, that delta there. And so what I'm going to do is I'm going to send, actually, I'm not going to send this straight edit. Let me just, I want to make sure it fills here. So I'm going to move this down just a little bit. I'm going to confirm and send, and we're going to put this in our short verticals category here. Send. Okay, we just sent that. We now have a short vertical on this. Now I'm going to stick with the same stock and talk about a long vertical. And then we'll compare the two and talk about pros and cons on these. Now, one thing when I look at that long vertical, one thing you'll notice is this, is I'm not going to choose the same strikes. Could I? Yeah, I could. On the short vertical, we did a 165 short put, and we did a 160 long put. Okay, that's how that works. If I'm doing a call vertical, a long call vertical, remember, this is a credit spread over here, that put vertical. If I'm going to do a debit spread here, okay, that's supposed to be DB, I'm going to do a call. I'm going to buy a call, buy the lower strike. I'm going to sell the higher strike. Okay, same in that regard, except they're calls. Okay, I could do the 160, 165, and you know what? A lot of the numbers would look very similar in that case. In fact, let me go back to that option chain here for a sec. If I were to go back here, we looked at this 160, 165 short call vertical. Let me add that in one more time, and I just want to look at this here. 165, 160. Okay, we want the stock to stay above the 165 level. Max gain 157, max loss 343. I'm going to tweak this a little bit. That 157, 343. See if we can remember that. I'm going to buy the call. I'm going to sell the same strike, the 165. Hold down the control key. I want the stock to stay above 165. That's my max gain on that. If I click on confirm and send, max profit 172, max loss 328. Not that different, okay? Not that different here. But these are not the strikes we're going to choose here. And one reason is this. Remember, that thing we say pretty much every time I give this webcast, short options can be assigned early. Look at this short call here. If we were to do these strikes with the stock close to 175 right now, this short call would be in the money significantly. And the odds of early assignment go up the more in the money you are and the closer you get to expiration. This is substantially in the money right now. Whereas when we did the puts and we sold that 165 put on the trade we just did, 160, 165. In the case of the puts, this right here, if the stock's at 175, these are both out of the money. Theoretically, the short contract could be assigned early. Realistically, it's pretty unlikely to happen if we're out of the money significantly. So if we're going to go for the higher probability trade where we use these lower strike prices, if we do that and we're doing them and we want to keep them out of the money, then we're going to do the short put vertical instead of the long call vertical. Okay, I'm hoping that makes sense. Let me know if you have any questions on that. Connie or I. Connie's very familiar with all this material too. She can help you as well on this. So now let's look at a different scenario here. I want to take, instead of this kind of high probability scenario with Salesforce, what if we do one where we say that balancing act between probability and reward to risk, where we emphasize the probability before, what if we emphasize a little bit more of the reward to risk? Stock right now is close to 175. What if we say, I want to give myself a little bit more upside? So instead of a 160, 165, what if we do something like a 170, 180? Okay? 170, 180. And so yes, now let me hit a question in the chat. Harry asked you a good question. The short contract is 165 in both cases. But remember, what's out of the money for a call is in the money for a put. What's in the money for a put is out of the money for a call. You can see that, by the way, when you look at your trade tab. And I don't know if you can see the shading here on this very well, but if you look here, look at the shading difference between up here, okay, and here. This is just black, and this is kind of this grayer-ish color there. Notice it's reversed right here. That represents the difference between in the money and out of the money on my calls and my puts. These are out of the money on my calls. These are out of the money on my puts, okay? In the money, in the money. So yes, on the short put vertical and the long put, the short put vertical and the long call vertical, the strikes are the same in our first example we were looking at. The strikes are the same. And the one that's short is the same, but one of them's out of the money, one of them is not. Okay, so that's the rationale on those out of the money contracts, why we do our short options, our short verticals out of the money. That's one of the main reasons why we do that. Okay, now let's take the higher probability approach here. And instead of doing the 160, 165 contracts, we're going to go with the 170, which is kind of, this isn't exact, but somewhere around there, 170 and 180 contract. Okay? 170 and 180 contract. Notice by shifting this up, shifting our strikes up, we're going to do a long call here or buy a call here. We're going to sell a call here. Notice a couple things. We're shifting the strikes up. Therefore, our probabilities are less. Remember, our max gain is when we're above the upper strike. We actually have to move up to get to above our upper strike in this case. Before, we were starting out above it. Okay? Now, what about the whole in the money, out of the money thing? In this case, by moving it up and having our short call at the 180, that is now out of the money. Stock's at 175. 180 short call is out of the money. Now, could that change throughout the course of the trade? Yes, it could. This 175, in fact, we hope it does. We hope this 175 goes up to 180 or even 185 perhaps. But even if it does go up to 180, the odds of early assignment are pretty slim when it's barely in the money. Now, as you get closer to expiration, that goes up, but we're not going to let it go all the way to expiration. We're going to get out about a week to go to expiration. So if this goes deep in the money, the odds go up. But that's the rationale on that. Now let's look at the strikes here on this. we were saying we were going to do a 175, excuse me, a 170, 180 long call vertical. So I'm going to go to the 170. I'm going to buy it. I'm just going to click on the ask price. I'm going to use the same strike, same expiration date in this case. I'm going to go to the 180 and I'm going to hold down my control key and I'm going to sell it. Now, what I want you to look at is this. Click on confirm and send and look at my max profit and my max loss. Remember, when we were emphasizing that high probability trade, the max profit was significantly less than the max loss. Right now, they're roughly equal. Max profit's slightly higher. When you're picking a long call vertical, okay, and I'm just kind of specifically talking long call vertical, or we were talking short put vertical earlier. I'm talking about the bullish variations of these trades, but most of what I'm saying applies to the bearish variations of these trades. That is the short call vertical and the long put vertical. But in this case, because I don't want to confuse you by switching back and forth, I just want to stick long or bullish trade to bullish trade. When we were looking at the short put vertical, okay, when we were looking at the short put vertical, this was very different. Now, what about our probabilities? In this case, remember when we were talking about the 165, 160 short put vertical, we said we just want the stock to stay above 165. Above 165 at expiration represented our max gain point. Below 160 at expiration represented our theoretical max loss point. In this case, our strikes are 180 and 170. Where's our max gain? Our theoretical max gain point is above 180. Our theoretical max loss point is below 170. We've lowered the probabilities. We've shifted the target area up. It's a more bullish trade. We have a better reward to risk ratio, worse probabilities. Now, let's use a little thought experiment here. Right now, on this particular trade, we're looking at the 180 and the 170. Let's consider what the difference would be if instead we did a 185, 175. How would that change the trade? It would make it our target higher, our max loss and max gain points higher. We're more bullish. It's a lower probability trade, but it would shift this significantly. Our max profit would go up significantly. Our max loss would go down significantly. The seesaw would hold. It happens. It's going to happen. The seesaw, remember, the balancing between the probabilities and the return on risk. The return on risk would go way up. The probabilities would go way down if we shifted to higher strike price. Which is the better trade? I don't know. If you're more aggressive, this one may be better. If you're more bullish, if you're a little bit more conservative, this one may be better. And if you think, I don't know if the stock's going to go up at all, I think the stock may go sideways, but I want to do a trade on it. I'm willing to sacrifice the reward to risk ratio. Then maybe you do that short put vertical instead. Do you see the differences here between these and the difference between the long verticals and our short verticals? So the bottom line on this, and I want to go to trade management and individual trades here in just a minute, but the bottom line is this. A lot of the difference in terms of the vertical spreads as we typically teach them, and I'm speaking, I can only speak for myself, but this is how we more often than not, you're going to see these demonstrated in the webcasts that we teach. If you watch Connie do a webcast, it's probably not that different in terms of the strikes we're picking here. If you want to do a higher probability trade where if the stock can be more neutralish, we're going for the short put verticals. If we're going to be more directional, we may do the long verticals, and you can shift the strike prices accordingly to tweak the trade a little bit. If you were to choose the same strikes, the numbers, the reward to risk numbers, the probabilities would be pretty similar. But remember, we're trying to keep those contracts out of the money as much as possible. I'm going to send this trade here in just 1 minute. Anytime you do a vertical spread, anytime you do a spread trade in Thinkorswim, it defaults it to the mid price. I'm going to go up here. I'm going to confirm and send. I'm going to review this, okay? Review this. I'm going to put this one in my long verticals category, send. And normally I wouldn't do two bullish trades on this, different types of bullish trades on the same stock at the same time. But in this case, it's a just a demonstration of one versus the other. I want to compare and contrast. Now, if this is not enough on entering these trades, tomorrow we have webcasts on verticals, long verticals, short verticals webcasts. Connie will take you further down the road than I did here today on this. She'll give you specific examples, not recommendations, but she'll give you specific example trades that you can practice in your paper money if you want tomorrow. Just check out those webcasts with Connie. Now that those are entered, let's go and let's talk about management of these trades. We talked about entry of these trades. Let's talk about management of these trades. With any type of trade, we're going to have an exit if things are going well, if things are going poorly, and if things are going okay, probably pretty much a time exit. This CRM trade is the trade we just entered. I'm not going to look at this because we just entered it. But let's look at AMD. AMD is kind of a loser trade right now. We're not doing so well. What kind of trade is this? This is a short put vertical spread. We sold the 470 put, okay? We sold the 470 put, and we bought the 460 put. So we want the stock to stay above 470. Where's our stock right now? 455. That's not good. And, it really shifted. We've had a lot of volatility. I mean, the market's been pretty volatile lately, but in this case, AMD is the ticker, right? AMD, okay. In this case, look, we were expecting it to continue up from here, and it looked promising, and then it just kind of reversed. And yesterday, we opened up here around 505, almost around 505, but we're now, I mean, that's a lot. That's a big move. 505 down to 455. That's like a 20% move in a couple days. 505 would be great on this trade. Not so much anymore though. That's a big shift. Here's the thing. Regardless of doing well or poorly, and obviously it's not going so well right now, we're going to get out when we're about a week to go to expiration. We got 8 days to go to expiration. We're going to get out of this trade, okay? Now, would you ever not get out of a trade with, I mean, if you can't lose any more than you've already lost, then maybe you stick with it and see if things turn out for you here in this case. But in this case, the current price is there's still quite a bit of value in this trade. How can I tell there's quite a bit of value left in this trade? Look at the current mark price of our two contracts. Okay? current mark price. Even though we've lost a lot, okay? Even though we've lost a lot of money, there's still about a $5 gap in the pricing on these. So it certainly could, it can get worse because we ultimately on this, we could get to a $10 difference. These are all kind of theoretical prices, losses. When I talk about losses, max gains, they're kind of theoretical prices typically because really, if we're talking about exiting a trade right now, it's you're subject to the price of the market of what it's going to give you. And you never know exactly what the market's going to give you. But that's generally how we're looking at it right now. Now, Mighty Mouse said, we can always roll this out. Yeah, you could roll this out. If you were, we got into this as a bullish trade. And if you're saying, this is just a temporary blip and this is still bullish, we could look to roll this out. Where would we roll it out to if we were going to roll it out? Well, we'd probably roll it out, the same rules that you'd use as if you were entering the trade fresh. In other words, typically on these short verticals, we're rolling out to roughly 30 days, roughly a month. And I say roughly, it can be longer or shorter, but we kind of want the higher time decay time period. Once you get in the money on these, your theta can shift though. Remember, we often talk about this positive time decay on short verticals when we do them out of the money. Well, that's not always the case. If it goes in the money, your time decay can start to work against you. At this point, though, 8 days to go to expiration, we're going to get out. Okay, we're going to jump ship out of this one. So we're going to get out of that. I'm going to right click. I'm going to create a closing order, and I'm going to buy this one back and cut any chance of further losses out there. Okay, all right. So that's that. So Mighty Quinn says, why roll if it's still remaining? You'd only roll if you're bullish and it would be the opportunity to do a trade you would do in the first place. Here's the reason you don't roll. Don't roll just because you're losing and you don't want to accept the loss. You roll when what you're rolling to would be a trade you'd be doing in its own right. Okay, we're not rolling today. Rolling is just closing out one trade and entering a new one. Okay, we're just doing it on the same order ticket. It does not save you commissions, by the way. Okay, now, so that's that one. AMD, not so great. APA, we still have 37 days to go to expiration. Plenty of time. Obviously, it's doing fairly well. It's a short put vertical. Stock's at 38 and change. We want it to stay above 35. It's above 35. We can look at the chart on APA if we want. APA. And it's, not super bullish, but it's not bearish. Okay. So it seems reasonable that we could stay with this. This is one, they're out of the money. Our time decay should be positive. Time decay is positive. Time decay is helping us out, okay, on this. So the only other reason we would get out of this, if we're not near expiration and things are going well and we're still bullish, is if we've made most everything we can make. If we've made 80% is often the number we'll look at on these verticals. If we've made 80% of what we can make, well, we're not at 80%, okay? We're not at 80%. We're at 31% right now. So I'm going to just stick with that, okay? We got one more in here, and I want to get to long verticals before I run out of time, and that's not going to be too long away. We're going to run out of time. Okay, first thing, 8 days to go to expiration. By the way, if you don't have this days till expiration column on there, you can add it. Just go up to your gear, customize column, and it's just called days to expiration, I think is what the name of it is, okay, for options. This is an iron condor, okay? This is an iron condor. Here's a short put vertical. Here's a short call vertical. Short put vertical, short call vertical. Our rules are going to be about the same on both. We're going to manage the iron condor there. We're going to manage the iron condor on, sorry, what I do, this, I put short put vertical twice. That's supposed to be a call. We're going to manage the iron condor as two separate trades. Okay, we may have entered it as one trade, one big trade, iron condor. We're going to manage it as two separate trades. However, in this case, the exit rule of about a week to go, we're going to get out, applies to both. So we'll look to get out of both on those. If it breaks down, bullish or bearish, one side or the other, then we'll consider it. This is the bullish trade. This is the bearish trade. And the stock right now is kind of in the middle there. So look, we're just going to get out of these. Let me close this out. Let me do this. I'm going to exit not as all four together. I'm going to exit as two vertical spreads. And the reason is because I think there's probably a better chance of getting better pricing if you try and sell out or trying to get a two legs filled at once than four legs filled at once. By the way, if you want to do more than one, you can just hold down your shift key as you click on it. And then you highlight them both, create a closing order, you buy that back. We're going to get out of this one. It's an extremely small profit, but we'll take it. Okay. All right. Now, and that one's thinking we'll let that work a little bit there. Okay. Let me just go and check chats. Thank you, Connie, for all your help on that. And I do need to wrap up here in just a sec, but let's do a long vertical. Long vertical. Abbott Labs. Same rule. We got a lot that are expiring in about a week, so we're going to look to get out of this. Are we making money or we're losing money on this one? Not doing so well. Look, we've lost a lot of money, 65% on this trade. And how is that calculated? Well, look, our initial trade was about 365. This is a debit spread. We bought it for 365. The current price is the difference here between those, which is about 125. Okay. From 365 to 125, we're losing money. There's still a fair amount we can lose on this. Is it possible we'd stay with this when we're losing money? Yeah, if this is near zero, we may say, look, we've lost almost everything we could lose on this. We're going to stick with this. That's not the case here. There's still enough that we can lose money on this. I'm going to close out of this trade for that reason. Create closing order, and we're going to get out of this trade. Okay, there's that. I think that is all I have time for. I was going to check out our trades. Sorry, let me bring this down. Our calendars and butterfly spreads, but I do not have time, everybody, today. So we'll hit that up next week. I want to thank you for joining me. I want to thank Connie in the chat. Always appreciate her. Make sure you check out Connie's webcast tomorrow. Long vertical webcast, short vertical webcast tomorrow. I appreciate you for taking some time out of your day joining me. Make sure you subscribe to that Trader Talks channel, everybody, so you don't miss future sessions. There's a survey. If you didn't hear me say it before, there's a survey, and we appreciate your feedback. Coming up next, we have trading price patterns. All right, everybody. Thanks for joining me. Have a great rest of the day, and we'll see you same time next week. Bye-bye, everybody.